So good morning, everybody, and welcome to this Dafferns Wealth webinar. My name is Martin Gibbs from Dafferns Chartered Accountants, and today is the 10th of February 2021. We are a few weeks out from the budget, which is due on the 3rd of March, and obviously the end of the tax year, soon after that on the 5th of April. So with that in mind, today's webinar from Dafferns Wealth is very well timed. Tax year-end planning in a COVID world. So yeah, the last 12 months have really turned everything on its head. A lot of people's plans have been put into disarray. And we have three experts with us here this morning to talk us through a whole host of planning aspects in advance of the tax year end. I have to say as well, just the parish notices that Dafferns Wealth is an appointed representative of Insight Financial Associates Limited, which is authorised and regulated by the Financial Conduct Authority. And the three speakers we have with us this morning, firstly, we have Steve Wheatcroft and then Rachel Legg, who are the two independent financial advisors from Dafferns Wealth. And also joining us today, we have Brian King, who's the private client tax partner for Dafferns Chartered Accountants. So over to you, Steve.
Thank you, Martin, and good morning. So to start off with, just a quick run through the agenda. As Martin said, we're quite close to the tax year end. We're even closer to a budget which could be quite significant. So we just want to run through the basic planning options, which, to be honest, we do every year. So the first part of the presentation is not particularly new. I'm going to run through income tax, capital gains tax, and look at some tax efficient investment options. And then Rachel's going to look through pensions and inheritance tax and look at planning opportunities there. But as Martin said, the third part of the presentation is potentially interesting. I'm looking forward to it. Brian King is going to try and anticipate some of the potential changes that could be brought about by what COVID has done to us. Because obviously COVID's had an enormous human cost, an emotional cost, and it's also had a huge fiscal cost. The Office of Budget Responsibility recently suggested that in the year 2021, it's likely to cost the economy £394 billion, and I suspect that figure will go up as well. And the government has already had to borrow over £200 billion in this financial year. That's seismic, and there will be implications. And one of the things that I think Brian will consider is, yes, 6th of April is obviously a critical point in all our sort of planning lives, but maybe this year, 3rd of March, 4 weeks today, could also be very significant, because that's when the Chancellor will stand up and give his budget speech. So I'm going to start off just quickly looking at income tax. We have a tax system which is in some ways generous. It offers lots of little allowances, reliefs, exemptions. So it's just important to know what they are and see whether you can take advantage of them. We know that in practice, a lot of people simply don't. So personal allowance, obviously we all know we can earn £12,500 each year before we pay any tax. And the next 37,500, taking us up to £50,000 of income, is going to be taxed at 20%. Once we get over 50,000, then we're looking at 40% tax on income up to 150,000. But also bear in mind that once income exceeds 100,000, it starts to bite into the personal tax allowance, and over 150 is 45%. So just make sure that you at least think about using all the allowances that are available. For example, there's a personal savings allowance. There's a dividends allowance that allows you to enjoy a little bit of tax-free income from dividends. And the one that really isn't used very much is couples do still have an option of sharing allowances. They can transfer up to £1,250 of allowances between themselves, just to use up some of any unused personal tax allowance. So all pretty basic stuff, but it's just worth bearing in mind. And of course, There's a very strong Dafferns tax team there to help you. Anybody has any questions, they'll be delighted to offer any support. Now, capital gains tax. I'm not going to talk a lot about capital gains tax because I know Brian will talk about this later. But obviously there are, again, there's an exemption, £12,300. It's amazing people don't use it. People make investments, shares, what we used to call unit trusts or collectives, and just sort of forget about it for 10 years, accrue quite a large capital gain, and end up paying quite a large capital gains tax bill. And it's really quite easy just to think about every year realising enough gain just to use the exemption, and that would quite often take out all or a large part of any liability. So just bear that in mind. Just try and use it if you can. Better than ISA and SIP, what we're really saying here is that if you've got money in a tax wrapper, which is going to give rise to tax liabilities, just think about gradually shifting it into another tax wrapper, which is tax-free. So if every year you can just realise enough money without paying capital gains tax to put £20,000 into an ISA, well, why wouldn't you? Because that's then going to be free of income tax, it's going to be free of capital gains tax, or maybe you use it to put into your pension. Just try and take full advantage of the system, basically. Again, independent taxation, couples are able to transfer assets between themselves and both have those allowances available. And of course, if there's any losses around, take advantage, use them and cover any potential gains. The final point I'm making here is simply, we would often say to people, if you're about to go into a transaction that will give rise to a capital gain, is it worth just deferring it for a few weeks until the next tax year? Because quite simply, that pushes back the payment of the tax by a year. So after 6th of April, you're looking at January 2023 before you pay any tax. Maybe this year, that could be a risk. Maybe the capital gains tax world might be slightly different after 5th of April. So not quite so sure that's a good idea this year, but who knows. So just looking at a few tax efficient options. Very basic, everybody knows you can put £20,000 a year into an ISA. Why wouldn't you? For couples, that's £40,000. Put it into a wrapper where there is no income tax, there is no capital gains tax. It's got to make sense. Just bear in mind that ISAs do not normally give you any inheritance tax benefit, but having said that, there are ISAs that do. So have a chat with us if you're worried about inheritance tax, because there may be options we can look at. Now, a hobby horse of mine is cash ISAs. If you've got money in a cash ISA, just think about it. You are guaranteeing that your money is going to fall in value. You'd probably be earning much less than 1%, maybe 0.1% if you're lucky. And with inflation at 2% and maybe about to go up, you're guaranteeing that the value of your money is going to fall. So if you've got cash ISAs, just think about alternatives. Stocks and shares ISAs sounds risky, but actually there's a huge range of ISAs that we can use with different degrees of risk. And if you can get into a one that has a modest degree of risk, but actually yields you about 5% per annum, surely that makes more sense than cash. So just think about cash ISAs. Now, the second point here, I'm just thinking about different wrappers. Different investments attract different tax treatments. Now, by collectives, I mean what we used to call unit trusts. If you've got investments, and the same applies to direct holdings and shares, you've got a portfolio that will generate capital gains, so you might be paying capital gains tax. Dividends that are paid out will be subject to income tax. Well, an alternative, and the model here is, let's try and think about using both, is something called a capital investment bond, which again we're very familiar with, run a lot of money through them. Lots of advantages. They can enable you to take a very tax efficient income. They carry a basic rate tax credit normally. And so, as I say, if you've got a decent portfolio of assets, investments, it probably makes sense to have a blend of different wrappers to hold them in. Now, the next two, we just don't think about enough. They're really potentially quite attractive. Since 1994, under John Major's government, we've had enterprise investment schemes. And basically, the idea was to encourage people to invest in young, growing businesses. And if you invested in a qualifying business, well, basically, you got up to 30% income tax relief. You could put in now up to £1 million, potentially £2 million if the company's involved in research and development. And once the money's in there, any growth is tax-free. You can defer capital gains by reinvesting proceeds into an EIS. And if you do generate losses, they can be set against income. And they're also potentially free from inheritance tax. There's a lot of tax breaks that go with enterprise investment schemes. I think the problem is people perceive them as high risk, because going back to the early days, investment in young growing companies was thought to be high risk because a lot of those companies might fail. Well, we actually only use these through professional managers. Now, the managers that we use vet very carefully the investments that they will put your money into. Well over 90% of the companies they look at are rejected as not being strong enough. So actually, a lot of that risk is filtered out by the manager's process. And also, the benefit is that they would normally put your money across at least 10 different investments. So again, that's spreading the risk. So given all those tax breaks, I just think more of us should consider using these schemes. Another option, which in many ways is similar, is venture capital trusts. Now, again, you can invest money into venture capital trusts and attract tax relief of 30%. You can invest up to £200,000 a year. And once that money's in there, any income that's generated or any gains that are generated are going to be completely free of tax. So they're just underused, and for people with assets available, they're a great opportunity. So I'm just going to finish off by looking at a couple of examples. The first one is Miss Williams, a successful businesswoman. Now, she recently sold an investment property for £300,000, and in doing so, she created a capital gain of £75,000. Now, £75,000 after the annual exemption leaves £62,700, which would be subject to capital gains tax, potentially £7,556, because she's a high rate taxpayer. Now, if she were to consider investing the £62,700 into an EIS and gets tax relief at 30%, then she will get a tax refund of £18,180. So the bottom line is she's got an investment of £62,700, which is actually, after capital gains tax deferral and income tax relief, only cost her £26,964. That's not a bad investment. Even if you did lose a bit of money, you're unlikely to come out behind. So, very attractive. And then, just another example looking at venture capital trusts. In this example, we've got a Mr. Jones. Mr. Jones earns most of his income in the form of rent from investment properties. So that gives him a bit of a pension problem, because as it's investment income, there's not much scope to pay any pension contributions. So in this case, we're saying, well, let's look at venture capital trust. Basically, he earns £50,000 a year in rent. The income tax on that at 20%, £7,498, well, let's say £7,500. Well, if he just takes half of that rent and invests it into a venture capital trust, he gets income tax relief of £7,500. He's made himself a non-taxpayer. He can do this year after year after year. The money that he builds up in the venture capital trust will hopefully grow, but the key benefit to a venture capital trust is that it will generate income, and that income is going to be tax-free. So when he gets to retirement, even if he's only got a modest pension, he can enjoy a totally tax-free income because he's accumulated money in a venture capital trust. So the message is, just think about it. Have a chat with us. We're more than happy to run through how it works and see how it could work for you. So I'm now going to pass over to Rachel.
Brilliant. Thanks very much, Steve. So your pension is one of the most tax efficient ways of saving for your future. Firstly, any personal contributions you make into a pension will benefit from tax relief. And it differs slightly regarding how this works depending on whether you're paying into your employer's pension via the payroll or whether you're paying into your own personal pension from your bank account. But essentially, if £100 is paid into your pension and you're a basic rate taxpayer, then you'll only have contributed £80. If you're a higher rate taxpayer, it gets even better because the ultimate cost of the £100 investment would only be £60. So a brilliant start in terms of pensions. Whilst your money's invested, it grows virtually tax-free. And when you come to draw the benefits, up to 25% of the fund can be taken as a tax-free cash lump sum, with the remaining funds being regarded as income and therefore being subject to income tax at your marginal rate. And this might possibly be lower at retirement than it was when you were working. The pot becomes even more tax efficient though, as any funds that you've left in the pension fund when you pass away are generally not included as part of your estate for inheritance tax purposes. So where in the past myself and Steve might have recommended using your pension pot first when you got to retirement and perhaps leaving other investments such as ISAs and stuff to draw on at a later date, more often than not, the advice will actually be to leave your pension pot alone and use your other assets up first. But of course, that all depends on your personal circumstances. Now, if you're in a situation, for example, where you are perhaps a director of your own limited company, you can pay into your pension as an employer contribution, which means you don't have to take money out of the company and potentially pay the tax on the dividends, but can move the funds directly into the pension where they'll be classed as a company expense, which will ultimately reduce the company profits and therefore the amount of corporation tax payable. This is generally the situation, but I would urge definitely taking some advice regarding your personal circumstances. So pension's really nice and tax efficient. And if you are thinking, actually I need to get another contribution in, or could I put a bit extra in for this tax year? Then I'd say don't delay. It's something we need to look at sooner rather than later. Thanks, Sophie. Now, one of the questions that myself and Steve have probably asked more than a lot of questions is, how much should I actually be putting into my pension? Well, first of all, we just discussed the fact that pensions are really tax efficient, so that's a benefit straight off. But if you've never gone through the process of building a personal cash flow plan, i.e. what have you already done towards planning for your future, and is that going to give you the kind of income that you require in retirement, then it's worth going through the process to see how much your pension contribution should be in order to help you achieve your required income. Now, unfortunately, because pensions are so wonderfully tax efficient, the government do limit the amount that you can put in. And currently the maximum that can be paid into a pension in a tax year and attract tax relief is what we call the annual allowance. And currently this is either £40,000 or 100% of your earnings, if that's actually less than 40,000. There is a rule called carry forward, which allows you to go back the last 3 tax years and use up any unused allowance. But be aware that if you're a higher rate earner, your annual allowance might actually be even less than that £40,000. In addition to the annual allowance, and you've probably heard of this, there is also the lifetime allowance. And that means that you can build a total pension benefit of over, or you can't build it over, £1,073,100. That might sound like a bit of an obscure figure, but that's because it is increased every year. And if you go over this amount, then there will be an extra tax charge. So to summarise all of that, if you want to maximise your pension contributions for this tax year, or you've got concerns that you might be affected by either the annual allowance or the lifetime allowance or both, then we're happy to have a chat with you. Thanks, Sophie.
Rachel, can I ask a quick question there?
Yeah.
You're talking about the maximum contribution you can make at 40,000, and if your earnings are less than 40,000, it's the lower number. How do you define earnings? Is it salary? Does it include dividends if you're a director shareholder?
It's going to be your salary, so not your dividends.
Okay.
Okay.
It's schedule A income, basically. Yeah.
Yes. Yeah. What you would class as any earned income, salary income. Okay. Right. Inheritance tax. So far we've focused on the things that really should be thinking about for this tax year and the immediate things. Inheritance tax is one of those things that actually can take a long time to plan for and get right. So we do want to touch on this. And inheritance tax is one of those things that's very difficult because there's so much information, so many rules to actually kind of try and do it as briefly as possible. But just to give you some of the summary points. First off, we've got the nil rate band. And this is the first 325,000 of an individual's estate. And this is taxed at 0%. Anything above that 325,000 is potentially taxed at 40%. Estates can be passed between a married couple without tax. And if you're married and your spouse has not used up their nil rate band on death, then the survivor can inherit the allowance, giving them £650,000 as a nil rate band on second death. Now, if you're not married, and this is really important, but you've got a partner, be really careful that you don't end up leaving your partner with an unexpected inheritance tax bill. Okay. Now, in addition to the nil rate band, you may well have heard of the residential nil rate band, which provides an additional £175,000 allowance in relation to the main residence only. And there are a number of provisos regarding this, such as this particular allowance only applies if the property is left to direct descendants, and if you've got an overall estate value of over £2 million, then that residential nil rate band is slowly taken away from you. So a number of things just to be aware of. There are a number of allowable gifts that you can make every tax year. I'm not going to go into too much detail on this in the interest of time, but it's important to always keep records of any gifts that you might actually make in the interest of reducing inheritance tax liability. And some gifts can take up to 7 years before they fall outside of your estate for inheritance tax purposes. And these are called potentially exempt transfers, or PETs for short. So how can you start to reduce your inheritance tax liability? So in addition to making gifts, one option is to use a trust. And there are a number of different types of trusts, and some will be more complex than others. Generally, however, you still need to live 7 years from placing assets into a trust before they fall outside of your estate for inheritance tax purposes. So advice is definitely recommended if you want to go down this route. Now, there are two types of trust actually, though, that myself and Steve can advise on, and those are loan trusts and discounted gift trusts. And unlike most other types of trust, these two options facilitate actually receiving an income, which actually is technically a return of a portion of the capital that you've actually put into trust, whilst at the same time ultimately potentially reducing the ultimate taxable estate. There is, as you'd expect, rather more detail behind this than we want to go into at the moment. But again, myself and Steve are more than happy to discuss these options with you. Now, I know that not everybody wants to give their money away or enter into a rather inflexible and complicated world of trusts. So a potentially more flexible option would be to use inheritance tax-friendly investment schemes. And these generally provide access to your money, although some are more liquid than others. But the key is that once the investments have been held for 2 years, the funds can be passed on to your beneficiaries free of inheritance tax. And these can even be held, as Steve mentioned a little bit earlier, as an ISA. So if you're looking at all of your assets and you're thinking, gosh, how can I do this effectively? But you're not dipping in and using your ISA pot, you could actually think about using some of that ISA provision that you've already built up and sort of shifting it into that more inheritance tax friendly environment if appropriate. Thanks, Sophie. Now, the idea of inheritance tax friendly investments, you might be wondering, how on earth does this 2 years thing work? How do we get it to fall outside the estate within 2 years? Well, it's actually down to government legislation and the 1976 Finance Act, when the concept of business property relief, now just known as business relief, was introduced. And it was actually moved to help certain types of businesses to survive when one of the owners passed away, potentially leaving a resulting IHT bill, which could result in breaking up the company. This has developed over time, but the principle remains that the ownership of one or more of these qualifying companies does not result in an IHT bill after 2 years of ownership. And this has been developed by a number of specialist investment companies that both myself and Steve deal with. And the offering of these companies is something that we can sort of advise on. And there are different levels of risk associated as well. So if you are somebody who would like to take a more sort of a route of capital preservation, we can examine that, as well as something that perhaps is a little bit more high risk. Again, on this slide, you can see that we've got the idea of business relief, and you can clearly see here that we've got the benefit of inheritance tax. But as Steve said, we don't use enterprise investment schemes as much perhaps as we should, because again, they are really useful for inheritance tax planning, because all of the lovely things that Steve's mentioned in terms of capital gains tax deferral, income tax relief, loss relief, they are also very good for reducing that inheritance tax bill. So if you've got any of those issues, it certainly is something that we could possibly consider for you. So that was a bit of a whistle-stop tour in terms of inheritance tax. But again, any of these issues, we can certainly have a chat with you about those. And if I may as well, just one thing to throw in there. Steve mentioned both VCTs and ISAs. You can actually have a VCT held in an ISA wrapper, which gives you a double whammy. So again, if you're sitting there thinking, gosh, actually a VCT would be really useful for me, but I've got no assets to put into it, I've not got the cash, you could, perhaps if you've got something held in ISAs, consider using some of the money in that wrapper and then wrap a VCT in the ISA. Okay, thank you.
Thank you, Rachel. In my part of the presentation, I will discuss some of the potential tax changes. I will highlight some planning opportunities and try to identify what taxes may be targeted in the short term, for example, the budget on 3rd of March. Capital gains tax, there is a lot of speculation that such changes will be made. And this comes about because the Office of Tax Simplification carried out a review in order to simplify capital gains tax. At the moment, capital gains tax is taxed at 10%, 18%, 20%, or 28%. So the general rate is 10% for a basic rate taxpayer and 20% for a higher rate taxpayer. But if the asset being sold is residential property, those rates increase to 18% and 28%, depending on the individual's other income. Also, there is an argument that capital growth seems to be taxed more favourably than income. It is possible to arrange an investment portfolio that goes for capital growth rather than income, and then each year the shares are sold in order to just use up the annual exemption, which is £12,300 in the current year. And so that would that amount would not be taxed at all. And also, if you did exceed the 12,300 annual exemption, then a higher rate taxpayer would only be taxed at 20% on the gain. And this is compared to income, which could be taxed at 40 or 45%. So I think there is a lot of justification that capital growth is taxed far more favourably than income. So what are the possible changes? Well, there is a serious suggestion that capital gains tax will be aligned to income tax rates, and there may be some measure to allow for indexation, which effectively is the rate of inflation over the period of time in which you've owned the asset. We could also find that the capital gains tax annual exemption is reduced. At the moment, it is £12,300, but again, there was a lot of speculation that this could be reduced to £5,000. And if this was the case, then for a higher rate or an additional rate taxpayer, this would incur an additional tax liability of around £2,000 based on the current rates. Also, if the capital gains tax annual exemption was reduced to £5,000, this would also double the amount of individuals who come within capital gains tax. There was also one tax journal that I read, which was suggesting that the capital gains tax annual exemption could be reduced to as low as £2,000. So possible, possible significant changes in this area. Another relief that has been proposed as being changed is what's called business asset disposal relief, or what was before that entrepreneurs relief. And there is suggestions that bringing back a tax relief called retirement relief. Now, under business asset disposal relief, if you were an employee owning 5% of the shares of a company that you worked for 2 years, you would get relief whereby up to £1 million of the gain would be taxed at 10%. And the proposed changes is trying to tie people into a longer period of time, and maybe an individual may need to own more than just 5% of the shares to qualify for a new version of retirement relief. You may have to own the shares for a longer period of time than just 2 years. And there's also a possibility that there may be a reintroduction of an age limit for you to qualify for relief. But people may not remember that when retirement relief was around until it was withdrawn in 2003, individuals had to be aged over 50 to benefit from it. So maybe this is a direction of travel where we're going on capital gains tax relief for owners of businesses and shares in businesses as well. What are the capital gains tax planning opportunities? Because of the wide speculation of changes to capital gains tax, it is sensible and for you to use your capital gains tax annual exemption for this tax year. This amounts to £12,300. But if it is possible, I would suggest that you use this allowance by 3rd of March, if at all possible. It is also possible that if one spouse owned some shares and they were showing a significant gain, then assets can be transferred between spouses. And for capital gains tax, that's treated as a transfer taking place at a no gain and no loss. And then this would enable the receiving spouse to trigger the gain so that a married couple could use up both of their capital gains tax annual exemptions. There is a bit of a tactic called bed and spousing, whereby if you have a particular liking to a particular share, then it is possible to sell the shares and for your spouse to buy them back. So that is a tactic, and the selling spouse will get the capital gain and the benefit of the annual exemption. Tax wrappers are also very good for shielding capital gains tax, to some extent income tax, and Steve and Rachel have both discussed the use of tax wrappers, but these are very, very good. And to some extent, they can give you flexibility as to when you sell the assets and trigger the gain. So considering what form of tax wrapper is suitable for you can achieve significant tax savings. If you've got tax losses within your portfolio, then it might be worthwhile realising those so that they can be offset against other capital gains that you can make, or capital losses are quite flexible where they are carried forward. Another possibility is that if this change, if you're going to be paying the equivalent of income tax rates at 40 or 45% for owning assets, then there is an incentive for individuals to own assets through limited companies, because limited companies will only pay corporation tax currently at 19%. So we may see a change in the way that assets are owned, especially property. Thank you, Sophie. Pension changes. For as long as I can remember, there has been speculation every budget that there is going to be changes to pension tax relief. So these speculations always revolve around reducing the annual allowance for pension contributions. Currently, it's up to a maximum of 40% or your net relevant earnings, as Rachel advised, but the 40,000 allowance could be reduced. There is also speculation that tax relief on pension contributions could be restricted to 20%. And also, at the moment, unused allowance can be carried forward for 3 years. But again, there is speculation that this could be done away with. So there are significant proposed changes to pension tax relief. So we need to just consider what is the tax planning opportunity that revolves around pension contributions. So if you can move on to the next slide. And really, I think it is sensible that if you were considering making a pension contribution in this tax year, to get it done by 3rd of March 2021, if at all possible. Now, just to touch on some other possible changes. First of all, corporation tax. Post-Brexit, and also to cover the cost of COVID, where there has been quite a lot of benefits given out to individuals and companies. I doubt whether there will be any significant changes. The UK has got to remain an attractive place to do business, and also the UK want to attract investors from outside of the UK to come along and do business within the UK. So it makes no commercial or economic sense to make significantly detrimental changes to corporation tax. If there was anything to be done, I would say it could be just raising the rate of corporation tax from 19% to 20%, but no significant immediate changes, I believe. The press is including quite a lot of speculation about the possible introduction of a wealth tax. And what is meant by a wealth tax is that a UK resident with assets above a certain threshold, and 500,000 has been mentioned, will pay a wealth tax at a certain percent, and this will be payable in instalments over perhaps a 5-year period. Now, the government did ask one of its government bodies to carry out a review of whether a wealth tax should be introduced. And the advice coming from that body was that it would be better if the government concentrated on changing capital gains tax and inheritance tax. Also, a wealth tax has been tried by a number of European countries, but their experience was that a wealth tax was hard to administer, hard to police, hard to collect the the income, and it seems as if it penalised individuals who had assets but no cash. So really, in terms of a wealth tax, I would say that it is very, very unlikely for a wealth tax to be introduced in the the coming budget or in the short term. Turning to inheritance tax, this is very much like pensions. Year on year, prior to the budget, there is lots of speculation that there is going to be changes to inheritance tax. Some of the proposals are that the inheritance tax annual exemption of 325,000 may be reduced. There is speculation that some of the exemptions and reliefs will be reduced, because at the moment we get generous reliefs for business property relief and agricultural property relief where they are at 100%. So they could be reduced. Another suggestion involves what happens on death. At the moment, for a married couple, if the first spouse dies, then they can leave all of their assets to the surviving spouse, and that is completely exempt from inheritance tax. Also, for the recipient spouse, there is an automatically uplift in the value of all the assets to the market value at the date of death. So there is a double benefit there to the surviving spouse moving forward. On the first death, no inheritance tax and an uplift in the market value to the market value of all the assets. There is speculation that you may not be able to benefit from both of those reliefs moving forward. If you take advantage of one, you may have to pay for the other. So that is a significant change if it happens. I think that there may not be changes or significant changes to inheritance tax in the budget on 3rd of March, but I think there is a direction of travel where inheritance tax may be viewed as a tax worth looking at and making changes. And in terms of planning opportunities, Rachel covered a number of these, but there are some investments where you achieve immediate inheritance tax benefits. They're referred to as discounted gift trusts if the individual circumstances fit those. There is 100% inheritance tax relief for investments such as EIS and VCTs after 2 years of ownership. And then you can also use trusts and make gifts. So there are plenty of opportunities in the short term to put in place inheritance tax planning so that you are protected in the future should there be some significant changes. But the amount of support that the government has given is so significant that a lot of commentators are saying that in order to pay for the cost of COVID, then one of the big 3 taxes will have to increase, and that is income tax, national insurance and VAT. In the short term, I don't see any changes to those 3 taxes, but again, it could well be something that will happen in maybe 2 or 3 years' time.
So, Tracy Hudson from HR Department, have you got a question for us?
I do, thank you, Martin. Yeah, my question was around dividends. Like, before there's the announcement in March, is there anything that we should be doing with dividends wise before March, or is that not an issue?
I don't think it will be. So I don't expect dividends to be increased in the budget on 3rd of March. But if you are thinking of paying a dividend and you were thinking of doing this late, just like March, then just to be extra careful and prudent, then start timing a dividend so it happens on 28th of February, at least you will lock in the the current rules. So my advice is that it's good planning to bring forward a dividend a month, just so that you are so careful and you get it under the current tax rules.
Okay, thank you.
There's also tax bands to think about with that as well. So the first £2,000 of dividends are free of tax, and then all the other dividends that fall within your basic rate band are taxed at 7.5%. And then if that pushes you into the 40% tax band, the rate goes up to 32.5%. So it's an extra 25% on the dividends that fall into the higher rate tax band. So for a lot of clients, it is a bit of a balancing act as to what the dividends are going to be and where they sit within the tax bands. Steve and Rachel and Brian, any just final wrap-up points you'd like to make?
Yeah, I think just on that last point, I don't think I'd be changing plans to make any changes before the 3rd of March. But if it's something you were likely to do anyway, there really is no downside to just getting in before the 3rd of March to be absolutely safe. I personally think it's unlikely we'll see that sort of change, but if it was part of your plan anyway, it's worth just thinking about bringing it forward. Yeah.
Okay. Rachel, any final point from you?
And just to say that we've got a considerable toolbox to help us reduce the tax liabilities that potentially we face. So always happy to give the advice and select what is right for each individual situation.
Thanks, Rachel. And Brian?
I think really the deficit has got to be paid at some point, and it's going to happen perhaps not significantly on 3rd of March, but some point down the road there will be significant tax changes. So I think people should start seriously thinking about tax planning, get advice from myself, Steve and Rachel, perhaps have a personal review, just so that they know what is possible. And things like trusts and some of the tax wrappers that Steve and Rachel have said, they are great, and they shouldn't put anybody off thinking that they're far too complicated or expensive. So seek advice, and probably get in touch with me, Steve and Rachel, and have an overall tax and wealth review and see what we can get in place.
Definitely, yes. I think the combination of a tax advisor like Brian and an IFA like Rachel and Steve looking at your affairs together can be pretty powerful. I think other stuff coming up in the budget, it's going to be interesting to see whether the stamp duty threshold on houses is going to stay at the 500,000 level. It's due to come down in April. Interesting to see whether that carries on. And there's obviously the 2030 deadline for people to be shifting over to buying some form of EV or hybrid car. There are big tax advantages for limited companies in moving to electric cars. It doesn't necessarily have a huge impact from a tax perspective on private individuals. So it'd be interesting to see whether they do any incentivization there. Balanced against that, of course, as Brian said, is there's a big deficit that's building up because of the COVID support. And I think COVID support and coronavirus, the coronavirus job retention scheme that's due to end at April, that's probably got to continue, and there may be further measures that need to go into place on VAT deferral. So it's going to be a very interesting budget, and certainly one to watch out for. There will be a Dafferns highlight video of the budget, so keep an eye out for that. And don't forget that there are 2 or 3 previous Dafferns Wealth webinar videos which have been edited down to about half an hour, and they are very good, so I would encourage you to have a look at those. But beyond that, thank you to Brian, Rachel and Steve. Please keep an eye out for the video. We'll let you know through the Dafferns website and through social media when it goes live, which will be later this week. Anything we can help you with, check out our website, dafferns.com, and hope to see you again on the next Dafferns webinar. So thank you.